Good day, everyone. Welcome to my monthly update on the asset management industry. I'm George Evans from Convergence. Convergence is a data and analytics firm focused on the asset management industry globally. Today, I will be speaking with yet another client guest, Matt Lowe. Matt is the head of the U.S. for Langham Hall, a over $100 billion fund administrator and a longstanding Convergence client. Following my conversation with Matt, we'll be talking briefly about some of the market share changes, and increases and decreases we saw in our league tables, which are produced monthly with fund administrators, auditors, prime brokers, and custodians. League tables are made available to Convergence clients, subscription clients, yet league tables can also be purchased at the Convergence e-commerce site. So I will provide some commentary on the movement we saw from April 2021 to April 2022. But first, so good day, everyone. I want you to welcome a great guest today, Matt Lowe. Matt is the head of the U.S., head of the United States for Langham Hall, one of the premier fund administrators in the market. Matt, thank you for joining us. Welcome.
Sure, George. Thanks for having me on. Appreciate it.
So, Matt, maybe for our listeners, I thought we could start with just you spending a few minutes on just Langham Hall, right, and kind of the
Great.
firm, the focus, and then we'll get into some real specifics.
Sure. Yeah, happy to give you a quick overview. So Langham Hall is a global fund administration firm. We are 600 people across 7 jurisdictions between Europe, Asia, and the U.S. We have about 140 billion of assets under administration across 450 plus funds. We also provide services pertaining to AIFMD for any managers marketing a fund in Europe. On that side of the business, we have oversight of about 102 billion of deposit assets across 120 funds as well. Despite our size, we've actually gotten quite large, but we're still actually independent. We're owner-operated, owner-managed. Very proud of that fact, and we plan to continue to do so in the same way. So for our firm, our focus is in the e-liquid space. Specifically, we work with private equity funds, real estate funds, debt funds, infrastructure funds, venture capital funds. We do not touch anything in the liquid space. We really just try to stay in our lane and do what we do and just do it really, really well.
Yeah, I mean, it's good to see the growth, right? And and the independence is interesting because there's quite a mix in the market today, right? As you well know.
Yeah, we see all the activity. We see all the activity.
I mean, I think we saw in 2021 almost 22 fund administration transactions, let's call them, and believe it or not, about 15 of them were done by European admins of the 22. On that overview, I'd like to talk about your business in 2022, right? So we're kind of approaching. Hard to believe they say time flies as you get older, right? So we're just at about the end of the second quarter, right? And
Yep.
Just want to get a sense how 22 is going and kind of how you're approaching the market and kind of what you'd still like to accomplish here in 22.
Sure. I mean, sure, it's not a surprise, but thankfully all of our businesses have been growing quite steadily. We're seeing growth with existing clients. They're launching new funds faster probably than they have in the past. I think that's across the market. We're also, fortunate enough we've been winning new business with new clients as well. So we've really seen growth across all jurisdictions and sort of both verticals, new clients and existing clients. Of course, that's also led to us hiring and sort of growing the business. As we've always done, we've always grown organically. We don't buy businesses. So we do sort of appreciate the discipline between, sort of making sure we're hiring people at the right pace and make sure we're bringing on clients at the right pace. I think we do a pretty good job balancing that. The labor market's been challenging finding people, but I actually think we've fared far better than many in the market. We've been able to really hire some really high quality people and been able to do it at a really good pace. So I think, throughout the, end of the year, I think we're going to continue to see that. I think there's going to be a lot of growth. I'd say our focus for the rest of the year of 2022, at least, is we certainly want to stay focused on our existing clients, helping to serve them as they continue to grow. Obviously, we're always looking to sort of win new business as well, but the goal is to just make sure that we're, hiring at a pace that keeps up with our clients. I think we've done a good job of that so far. We have to continue to do so. Make sure that we're bringing people in, training them properly, making sure we're setting our people up for success. That tends to, fare well for both our own internal teams and for our clients as well. And I think we're just trying to sort of, keep our head down and stay focused on what we do. I don't think there's any sort of, I don't think there's any sort of magic formula there. I just, we sort of, we know what we do, we know how to do it. We just have to make sure we're executing every day.
Yeah, I mean, it's a good point, kind of keeping your head down, and certainly the growth story is solid. We see it in your numbers and some of the work, analysis that we do. You touched, this will work its way into a little bit of my second question, Matt. You touched a little bit on hiring. So, I want to talk about kind of the return from COVID, right?
Sure.
And
Yeah.
kind of what are you seeing? What are you guys doing? What are you kind of doing that's different? So, maybe we could start with just, we often hear about the war on talent out there, right? That it's difficult to find people, get people in the office. Maybe you could first talk about COVID, right?
Sure.
How has Langham Hall changed? What are you guys doing a little differently because of COVID? And then let's kind of finish that with just how it's impacted, or has it impacted kind of your hiring?
Yeah, I think during COVID, first of all, I mean, at a global level, we really have tried to remain sort of like-minded. We have 7 offices. We're, Europe, we're in Asia, we're in the US, but we really have worked very hard throughout all of COVID, really, the management of the firm to try to sort of stay the same course across the firm, across all offices. So, of course, that requires some balance in that, every jurisdiction has been affected slightly differently. Every, people in different jurisdictions have reacted differently. And so, to some degree, there's been some nuanced differences, but I would say as a whole, I will sort of say the following, we are sensitive to people's needs for flexibility right now, which I think is sort of the big topic at this point when it comes to what people are doing or not doing. We really do find that learning slows down when we're physically detached, right? So it is our preference to be in the office. We are in the office right now across all offices. Our goal is to continue to be in the office. And it's in our view, a complete remote environment is not beneficial for our teams, not beneficial for our clients. So we really do feel that's the way forward. That's what we speak about. I think we were one of the first firms to get back in the office after COVID. Again, to varying degrees based on the jurisdiction and obviously the local, requirements by law. There were certain places that were allowed back a bit sooner than others, but it has always been our goal and will continue to be our goal to get people back in the office and to be in the office together. We think we're better off that way.
Did you find the team was kind of supportive of that in general? Or did you have a little bit of a mixed view of that?
I think, one thing we really try to do, I mean, I guess I'll go back on the first point. Flexibility is something we've always prioritized, even before COVID. I think there's a difference between working at home all the time, which, I know some firms have chosen to do, which we have not, and flexibility, right? So I think one thing we try to do is explain to our team why we want people in the office. It's not just for FaceTime. There are real benefits to being together in the office. And we've always emphasized flexibility long before COVID was a thing. So I think when people realize, listen, this is what's best for me. This is what's best for my growth professionally. This is what's best for the team. People have not pushed back too much. And I think also when people realize that we are very serious about the flexibility and making sure that people have it when they need it, I think it feels almost better, knowing that the flexibility is there when you need it. Particularly with sort of personal obligations or things like that.
I mean, listen, it's interesting. It's a good way to put it. Like one of the things I've seen, and we even experience here at Convergence, we kind of have this hybrid model where people are in and can be out. But what we try to do, because you make a very good point about the connectivity versus the detachment, right?
Yeah.
we don't keep it loose in terms of you can be in any day you want or you know, we want people, if everybody's coming in the office, we want them all in the same, say, 3
Sure.
days, right? So getting that maximum exposure and connectivity. But to your point, we're also being flexible and you know, with some of the personal demands. I mean, you have people with children, you have, you know, it's a, you know, I think it's just at the very beginning, before we move on here, of potentially a very different way the world will work, right?
Yeah. I mean, my least favorite part of the whole COVID cycle, let's call it, I guess, obviously other than extreme lockdown, but in terms of like just getting back to office, I remember in the early days, particularly in New York, there were a lot of rules about who could be in the office, who couldn't, certain numbers, you know. That was actually, to your point, we wanted to get back as quickly as we can. Of course, we wanted to follow all the regulations and guidelines, et cetera. That was a challenging time because we had to sort of forcibly make sure we weren't all in at the same time. And that was actually quite frustrating. It was good that we were in, but I happen to agree with you. You know, it's better to be in together. That's exactly why we want people in. It's not just to show your face, it's so that we can collaborate together. We tend to train people better. We tend to learn from each other faster. You know, in our office, we have a couple of stools that just pivot around the office because people oftentimes will sit next to each other at each other's desks to sort of just work on something together or do some training. And so at one point we realized we just, you know, we need these stools to just be readily available so that someone can grab one and slide up next to someone's desk and help them out. So
yeah, it creates that right dynamic, right? I think it's a lot easier to, you know, whiteboard on a real whiteboard than on a Zoom, right? So let's switch gears. So the markets, right? So I you know, I look at them every day. It's been a rough 22 in terms of the markets, right? You know, how have you seen the markets impacting, you know, your clients, your business? You know, certainly assets are down, and that can create a real dynamic at an advisor if expenses go up or stay don't change at that same pace, right? It can, you know, we've seen things like you know, outsourcing's picking up from self-admin, lift out conversations are picking up. Curious, you know, what you're seeing in the first, you know, 6 months of the year relative to, you know, kind of this market volatility and you know, downward spiral that we've seen so far.
I mean, thankfully, everything you're saying, I mean, obviously we're seeing the same sort of stuff in the volatility, particularly in the US market, right? There's obviously been a lot of volatility. The US Fed has all but said they're going to force a recession at some point just to get inflation under control. So, you know, we see the same headlines you do. You know, I will say that so far, at least in terms of the first half of the year, it has not really adversely affected our clients too much or us. I think there is some trepidation about, you know, how it will in the future. And I think, thankfully, we work with some really great clients that are very thoughtful and always sort of planning ahead. And because of that, I think they're sort of planning for certain volatility that could come. And so I think it's good that they're planning. But for the most part, our clients have done pretty well. You know, we've had some clients have some really great realizations, you know, despite sort of the volatility in the public markets. The biggest thing that's been the most interesting, though, is the fundraising environment. You know, and I don't, there's one thing for sure is that there are more clients coming back to the market than ever before, faster than before. The speed at which a client will raise a fund, do a final close, and get back in with another fund is faster than I've ever seen in my career. I do think it's kind of the way of the world. I think it's the future. I don't think this is a short-term trend. I just think it's sort of assumed that you're almost always in the market fundraising. You know, there'll be little breaks, but not long ones. Now that's created something very interesting is that LP capital, you know, the LPs have to allocate, of course, and all these allocations are drying up much sooner. I've spoken to a few people in the market recently that have no LPs who've already allocated all of 2022 as early as April, and even now, you know, and we're, you know, around May, June time, right? So that's become very interesting. I spoke to someone recently who said that they had an LP who was starting to allocate for 2023 already. You know, midway through 2022, which is very interesting. So
yeah,
that's been, say again?
Very early, yeah.
Very early. I think the logic has been that an LP, although they can't legally say don't call this, they sort of feel that if they're committing, right now we're around, the June period, June, July, well, then maybe they can encourage the GP to use line of credit for a few months. And so they don't really get their capital called for real until, December, January. So I think that's sort of what they're relying on. Now, obviously there's no legal basis there. If capital is called, the LPs will obviously fund it. But I think what we're seeing is the LPs don't want to miss out on good opportunities. And that's why they're willing to go into the next year. But that has created sort of an interesting situation, because there are a lot of funds, both existing clients with new funds or existing managers with new funds and new managers, emerging managers in the market. And so I think it's created, as you can imagine, a bit more competition there for all of the above. I was speaking to a placement agent recently and said they might have, an LP on average, in his view, would be looking at 5 funds in any given day, any given period of time, and now they're looking at 15.
Yeah, right.
Yeah.
So that's interesting. So let's finish. And I just want to say, as we look forward, right, to the rest of 22 come before us, what are your plans beyond kind of staying the course, right? You're kind of you've been off to a good start. Growth is good. I think COVID feels like it's settling down, right?
Yeah.
We'll famous last words, but right. Just your thoughts on kind of how you guys want to finish strong here in 22.
Similar to what I said before, we don't buy businesses. We're not looking to be bought ourselves. So for us, it's just about, sort of staying focused on our clients, focused on their needs, trying to always figure out how to get a bit better, how to help them out a bit more, things like that. Really just working on the basics, making sure we're hiring and training good people. We're not, I think because we don't buy businesses, we're not focusing in, and because we don't focus our efforts on integrating businesses, right? We really just try to focus our efforts all the way from the senior members of our firm, to the person who just started yesterday. We really try to focus all of our efforts on our clients, and that's sort of how we set ourselves in the market. There's a lot of senior level attention with our clients because we're solely focused on the work and sort of providing the services that we promise to our clients. So I think that's what we've always done. I don't think that's changing anytime soon. Certainly, I don't think it'll change ever. And that's really what we're focused on for 2022, the rest of 2022.
You make a good point, because your guys' reputation in the market is certainly one of high touch and excellent customer service. And
thank you.
You've got nice retention numbers. We see them, right? We know how sticky your clients are, and I think that's a testament to some of the good work that you do, and to your point, some of the distractions you don't have, right, in the market. So listen, I want to thank you for joining us. I wish you the best. We've always enjoyed the Convergence relationship with Langham Hall, and I wish you and the firm just a strong finish here for 22, and thanks for making the time for us today.
Sure, you bet. Thanks, and same to you and your team as well. Looking forward to continuing to work with Convergence going forward, and thanks for taking the time.
Turn our discussion just briefly to some of the market share changes we saw and growth we saw over again the last year, April of 21 to April of 22. I'm going to start with fund administrators. We saw assets grow about 16% year over year. And when you think about the distribution of those assets, this played out this time period kind of very interestingly. Admins 1 through 5 grew at about 25% versus that market growth of 16. Admins 6 to 10 grew only at 11%. And admins 11 to 25 grew at close to 24%. So both the top 5 and then the 11 to 25, significantly outpaced the market. Admins 6 through 10 trailed the marketplace, and that's certainly something we can talk to you about in the market if you're one of those admins that is 6 to 10. Let me move to fund auditors. Again, we're looking at the assurance practices of auditors. Again, looking at that 16% growth. these results are interesting to me for this time period, April 21 to April 22. We saw the big four grow at just a little over 7% compared to 16% growth for the industry. Auditors 5 to 10 though grew at pretty close to 29%, which is pretty stellar. And auditors 11 to 25 grew at very close to 27%. So clearly seeing a trend here where really new business and funds that are appreciating, we saw the bulk of that growth really in auditors 5 to 25 over this time period. Even with the prime brokers, and with prime brokers, we look more at fund level activity. So we saw funds grow at the primes about 15%. And when I look at that distribution, I think this is a telling story. Prime brokers 1 to 10 grew at just about 3.2%. And prime brokers 11 to 25 grew at close to 7%. So neither grouping keeping pace with the market in the top 25. We found all other prime brokers, so that means 26 on, grew at very close to 14%. So you're clearly seeing over that time period, most of that business going to prime brokers 11 to 25 and 25 plus. And then I'll finish just with some quick views on funds for custodians. Same type of measurement that we have for primes. So, we saw fund growth over that time period for custodians be about 14.5%. And when we looked at that distribution, custodians 1 through 10 grew at about 11%, and custodians 11 to 25 only grew a little over 1%. And then all other custodians, 26 on, and believe it or not, there are 1,400 custodians that service the SEC registered market, grew at close to 17%. So we're clearly seeing here that, the top 10 really held their own, but the bulk, that middle pack, 11 to 25, did not see much growth at all. And then when you got to kind of 26 on, we saw really a fair amount of growth. So it tells us that clearly that business is moving down market, and in this time period, moved pretty significantly. A pretty significant amount of business moved down market. So all that detail is available in our league tables. If you're a client, you get that from us every month. If you're not, and hopefully a prospect, that's certainly something we can share with you. So I want to thank you all for joining me. I want to thank Matt Lowe for joining us this month. And this is, I believe, our 19th straight episode and podcast that we've had great viewership. And you can listen to this in detail at the Convergence website, on YouTube, and on our LinkedIn page. So thank you all for joining me, and I look forward to speaking with you all in the month of June. Have a good day.